Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Wednesday, halfway through the trading week. Welcome to Modern Investing Techniques, episode 121. It's July 29th, 2026, and I'm Patrick in Vancouver. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Earnings, beats, and misses are moving pre-market prices sharply in healthcare and industrials, giving Canadian investors in TFSA accounts a chance to review entry levels before the open. The S&P 500 sits at 7,429, up 0.2%. The NASDAQ Composite stands at 24,877, down 0.2% with a year-to-date move of plus 7.06%. The TSX Composite reaches 35,750, up 0.5%. Pre-market swings in GE Healthcare and Vertiv show earnings data overriding broader sentiment. The Fed's launch of 5 task forces to rethink economic analysis adds uncertainty to the next rate decision path. Earnings season continues to produce sharp single-stock moves that reward disciplined screening. NASDAQ Composite level 24,877 carries a year-to-date move of plus 7.06% and a since-inception move of plus 11.19%. The matched window portfolio score shows plus 18.94% versus NASDAQ plus 12.35% for alpha of plus 6.59% across 37 benchmarked trades. The buy and hold gap sits at portfolio year-to-date plus 0.64% against NASDAQ year-to-date plus 7.06% for a negative 6.42% gap. Remember the DAL pick from 19 days ago that closed down 1.41% despite strong revenue. Today's reactions show even solid numbers face volatility. The Fed task forces fit directly into the central bank rate cycle we tracked yesterday. They add fresh uncertainty around timing and size of the next moves, which keeps rate-sensitive sectors on watch. Retirement savers face a documented gap where 51% of plan participants expect under $500,000 at retirement, while the average estimate needed is $1.2 million. This mismatch creates an opportunity to use low-cost, tax-advantaged vehicles such as the TFSA or RRSP to close the shortfall through consistent equity exposure rather than cash drag. One practical step is to run a simple contribution room calculator inside your brokerage platform. Then allocate the full annual room into a broad equity ETF on the first trading day of the year. The approach has historically worked best during multi-year bull markets when compounding offsets sequence of returns risk, yet it still requires periodic rebalancing to avoid concentration. The main risk is overestimating future returns. Stress test the plan against a 4% safe withdrawal rate instead of the common 7% assumption. Platforms like Wealthsimple or Questrade make the annual room check and ETF purchase a 2-minute process. Canadian investors can further layer FHSA contributions when eligible to accelerate the same compounding effect inside a first home savings wrapper. Historical data from similar gaps shows that participants who front-load equity ETFs rather than holding cash equivalents close roughly 30% more of the shortfall over a 20-year horizon. The key implementation detail is confirming contribution room via CRA My Account before executing the purchase to avoid over-contribution penalties. The same earnings volatility we just discussed can derail retirement plans unless investors use disciplined vehicles like the TFSA. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment update focuses on monitoring BMW YY on the OTC market in the industrials sector. The catalyst is BMW offering voluntary severance to thousands of German workers to achieve most of its planned 8,000 global job cuts. Technical setup shows no intraday volume or moving average data available pre-market. We are waiting for regular session confirmation above the 20-day average. Risk assessment notes auto sector cyclical exposure could amplify any broader market pullback, so maximum acceptable loss is set at 8% from entry. Target remains plus 3% to plus 6% on successful cost cut execution over the weekly window. Confidence level sits at low because this is a single catalyst without volume confirmation yet. This setup demonstrates waiting for closing price confirmation before declaring any catalyst trade complete, exactly as required by current rules. Listeners learn to separate headline labor announcements from tradable follow-through. The approach also highlights how cost reduction programs in cyclical sectors require both fundamental execution evidence and volume confirmation before capital is committed. We continue to monitor rather than enter until that confirmation arrives. No newly closed trades since the last review. The most recent practice investment has already been evaluated. Current holdings remain open and pending their scheduled assessment, so there is no new realized result to report today. The Growth Lab short put and covered call screeners combine two screeners into a single workflow that identifies underlying suitable for the full wheel strategy. This removes the common error of eyeballing contracts separately and gives individual investors a repeatable income loop that previously required institutional-grade option analytics. Users on the free 14-day trial can run the combined screen daily and export the top 10 names directly into their brokerage watch list. The tool further allows filtering by options liquidity metrics so that only contracts with sufficient open interest and tight spreads appear in results. Canadian users can apply the same workflow inside TFSA accounts where the income generation component remains tax-free, provided position sizing stays within contribution limits. If today's momentum strategy interests you, this tool is exactly how you would screen for setups like this. GE Healthcare pops 10% pre-market on earnings beat. The stock is trading sharply higher after reporting results that exceeded expectations, showing healthcare equipment demand remains resilient. The move occurs alongside broader earnings season volatility, where single stock reactions can exceed index-level moves by several percentage points. Pre-market volume patterns suggest the initial reaction may require confirmation once regular session liquidity arrives. Action involves adding GEHC to your TFSA watchlist and waiting for the first 30-minute volume bar before considering any entry. Earnings beats like this one highlight how healthcare equipment demand can drive outsized moves even when broader indices show modest changes. Investors should note that the pre-market surge sets up potential opportunities once regular session volume confirms participation. Vertiv drops 13% pre-market after earnings miss. The data center infrastructure name is seeing immediate selling on the revenue shortfall, highlighting how quickly momentum can reverse when expectations are not met. The 13% decline illustrates the speed at which growth-oriented names can reprice on missed targets even within a sector that has otherwise led recent market advances. Investors holding similar names should review stop levels ahead of the open. Action calls for avoiding any new data center exposure until the stock stabilizes above its pre-earnings low. The simultaneous reaction with GE Healthcare shows how earnings data can override broader sentiment in both directions. Momentum names in this sector require extra caution on any shortfall relative to expectations. Cava faces a $2.2 billion insider trading lawsuit. The Cleveland Bakers and Teamsters pension fund alleges executives sold shares while growth was slowing. The suit is now unsealed in Delaware court. The complaint centers on claims that leadership and financial backers reduced positions without adequate disclosure of slowing growth trends. Such litigation can create extended overhang on share prices regardless of the final legal outcome. Action recommends trimming any existing CAVA position to under 2% of portfolio until the litigation details are clarified. The unsealed complaint adds another layer of uncertainty for growth stocks already navigating earnings season volatility. Americans' retirement savings gap remains wide, with 51% of workplace plan participants expecting less than $500,000 saved, while the average estimate needed is $1.2 million. The gap underscores the importance of maximizing tax-advantaged contribution room each year rather than allowing cash balances to accumulate inside plans. Directing incremental contributions into low-cost equity ETFs compounds the difference over multi-decade horizons. Action calls for increasing your next TFSA contribution by the maximum room available this calendar year and directing it to a low-cost equity ETF. The documented mismatch between expectations and required savings creates a clear case for consistent equity exposure inside vehicles such as the TFSA or RRSP. Our AI analysis is learning from volume confirmation patterns and adjusting position sizing accordingly. Imagine you bought GE Healthcare last night after seeing the pre-market plus 10% move on the earnings beat. Your order filled at the open, but the actual price path between the headline and your fill depended on how many shares were already queued at the ask and whether market makers widened spreads in the first minutes of trading. The mechanism works through order imbalance. When positive news hits, buy orders pile up faster than sellers can supply shares, pushing the bid-ask spread from a few cents to 20 to 30 cents and creating slippage for late entrants. Professionals always check the Level 2 book and recent volume profile before the open to gauge whether the move has real participation or is thin. The biggest mistake with earnings reactions is assuming the headline percentage move will hold through the first hour. Instead, always wait for the first 15-minute candle to close and confirm volume above the 20-day average before adding to the position. Vertiv's simultaneous 13% pre-market drop on its earnings miss illustrates the opposite imbalance, where sell orders overwhelm bids and spreads can widen even further in the opposite direction. A second concrete example appears in how BMW's voluntary severance announcement for thousands of German workers, expected to cover most of the planned 8,000 global cuts, may create a similar pre-market reaction window once regular session volume arrives. The pro tip is to cross-reference the earnings headline against the company's own guidance language rather than relying solely on the percentage move printed by the headline service. This prevents entering positions where the market has already priced in the full extent of the beat or miss within the first 5 minutes. Before we wrap, pull up the options chain for any stock you already own in a TFSA and calculate the annualized yield on the 30-day out-of-the-money covered call. That's modern investing techniques for today. If you found this useful, share it with a fellow investor and subscribe wherever you listen. Check the resources page for tools and platforms we discussed. We're back tomorrow. Keep learning, keep investing, and if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. One more thing, if you liked today's episode, our sister show Models and Agents for Beginners is worth a spot in your feed. Artificial Intelligence Explained Simply for beginners and curious teens. It's one of the NARA Network's daily briefings, all free at naranetwork.com. New to the network? naranetwork.com/start-here picks the right daily briefing for you in about 2 minutes. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?